This is Maltbie's Minute on the Market. Welcome to the dog days of summer, where Wall Street takes off for a good 3 weeks out of the year, and they wind things down. Go to the Hamptons, go to Newport, Rhode Island, go on a safari, just get away from work. So we've got a market that's been unusually quiet. At the same time, all the volatility has been confined to the political arena, which tells us that this market has a strong belief and conviction in leadership in the administration and their platform. It isn't budging despite the mayhem, knock on wood. So we are going into seasonally the worst period of the year, August through late September. A market that is up over about 20% since the Trump election. And leadership has been confined predominantly to tech, the obvious characters there, and big cap overall. And small cap is left in the dust here. So our indicators also, coinciding with this slow period, have gone slightly bearish, driven by our liquidity indicators, meaning buyouts and M&A are down. It's also earnings season. So let's go to the charts for a closer look at some of the risks we want to be concerned about. Chart number one, this shows money flows, a huge amount of money flowing into ETFs since 2008, since the last crash, to the magnitude of over $2 trillion. Accompanied by that money really looking to come directly out of actively managed mutual funds to the same type of magnitude. In fact, JP Morgan has pointed out that 60% of all the market activity is from ETFs and indexes. Talk about a growing power and force in the market. While that has been occurring over the last longer period, 17 years, we've seen a lot of volatility and then a lack thereof. This is where we are now. We're at a 17-year low in volatility. Now, let's look at market leadership. This shows the S&P versus the microcap index. There's a huge spread right now of over 1,900 basis points, showing that fewer and fewer stocks have been working on this leg up. The question is, will that change? We want to combine this with a red alert, with a factor of another risk element, which is a new product on Wall Street. While they've had declining fees and declining commissions, you've had them create, the geniuses on Wall Street, a new product to provide a decent type of a return in income. It's called an SBL, security-based loans. No one knows the magnitude of this, but we do know the New York Stock Exchange is at near all-time leverage lows, meaning margin accounts are at highs. These SBLs are starting to grow very rapidly, and they can be used for many diverse things, not just securities. So we have a situation with a match that could strike the powder, that could blow up the dynamite, blowing up into a huge downfall when you look at what could happen here. Evidenced by consolidation in fewer stocks. The time to sell these through ETFs is much sooner. And a huge amount of leverage. What will get that process started, no one knows. That remains to be seen, but there is a high level of risk. So you want to beware. So, visit our website, millennium-asset.biz, for more information. And stay tuned while you're in the dog days of summer. Don't fall asleep. I'm Robert Maltbie. This is Maltbie's Minute on the Market.